Hello everyone. So in today's video we're going to understand why inflation is rising in India. So if you talk about in the Indian context, inflation in the last decade in India has been fairly low. In fact, if you look at the wholesale price index, you'll observe that in the last 6 months, between June of 2025 and December of 2025, inflation in India at a wholesale level was almost zero or negative. However, inflation has started rising in India rapidly since March of this year. And in fact, in June of this year, the inflation was as high as 9.87 at a wholesale level. Now, this is a very high level of inflation for any economy, and this is gradually going to impact the inflation at a consumer level as well. In fact, there is evidence which also shows that it has already started impacting inflation at the consumer level. If you look at CPI, you'll notice that the inflation at consumer level for the month of June was 4.38%, which used to be as low as 2.7% in the year of 2025. Now, this inflation of 4.38% is slightly higher than the RBI's target of maintaining an inflation around 4%. So in today's video, we're going to understand at a deeper level what are the factors, or specifically what is the key driver of inflation which is happening nowadays in India. So before we do that, let's quickly understand what does inflation even mean. So if you talk about inflation, inflation simply means a sustained, so that's the key word out here, it means a sustained increase in general price level in an economy. So the two keywords out here are sustained and general price level. So when we mean sustained, when we say the word sustained, we mean that it has to be a continuous increase in prices. So that's the first thing. So it should be a continuous increase in prices, and we are talking about general price level. So if in an economy only a price of a particular commodity is rising, then that need not be inflationary, because could be the supply of that commodity for some reason has reduced. But if you have a general price level rise, say the prices of tomatoes, potatoes, say the price of milk, the price of transport related services, the prices of clothing, the prices of footwear. In general, if there is across the board increase in price of commodities, then on a continuous basis, then that is referred to as inflation. So it has to be across the board. So this is what inflation is. Now, inflation can be because of two broad set of factors. So the first set of factors are your demand pull inflation factors. That is, if in any economy the aggregate demand exceeds the aggregate supply, that is the collective demand in an economy at a given point of time is more than the supplying capacity of the economy at that particular point of time, then that excess demand is going to result in a price rise, and that is called as demand pull inflation. The second set of factors or drivers are what are called as cost push or supply side inflation factors. That is, you could have inflation in an economy because there is a reduction in supply of commodities, or there is an increase in cost of raw materials used to manufacture certain commodities. If you talk about in the Indian context right now as to what is driving inflation right now, it is actually the supply side factors and not the demand side factors which are driving inflation. So these are the drivers of inflation in India right now. So given that it's the supply side factors which are causing inflation in India right now, let's understand how these supply side factors are causing inflation firstly at a wholesale level. So to understand inflation at a wholesale level, you have the wholesale price index, which is essentially a average. It's a weighted average of three broad category of commodities. So to measure wholesale price index, you have the first category of commodities, which are your primary articles. So this includes foods, minerals and so on. The second set of category of articles are your fuel and power, and third category of articles are your manufactured products. So what we're going to do for the remainder of today's video is that we're going to understand how supply side factors are actually driving inflation in these three broad category of commodities. So before we do that, if you look at wholesale price index and what is actually driving inflation at right now, you'll notice that the key driver of inflation or wholesale inflation right now, the first key contributor are your manufactured products. After that, you have your fuel and power, and third, you have your primary articles. So that is in the descending order. The key driver amongst these all articles at a wholesale level, if you talk about inflation, are your manufactured group of articles, and then it's followed by fuel and power, and finally primary articles. So let's understand first now as to how supply side factors are causing inflation in a broad category of primary articles. So if you talk about in the broad category of primary articles, it is actually agricultural led supply shock which is the key reason for inflation. So you have a agriculture led supply shock. So to understand what this means, let's take an example. So let's say there is 1,000 tons of tomatoes which reaches the vegetable market in New Delhi on a daily basis. Now let's say because of poor monsoons, what has happened is that the output has reduced and you only have 600 tons of tomatoes which are reaching the market. Now given that the demand is still the same, however, the supply has reduced. So this excess of demand over supply is going to result in a rapid price rise. In fact, if you talk about the food inflation which is happening in India since mid of 2026, it is actually these supply side factors which are causing. So in India, what is happening is that in anticipation of El Nino and poor monsoons, you actually have farmers who have not sown as much of crops as they usually did. So as a consequence of this, wholesalers and retailers are already anticipating that they're going to be getting fewer amount of grains and vegetables in the future. So in anticipation of reduced supply in the future, they have already started increasing the prices, and that is the key reason. That is, this anticipated negative supply shock is the key reason why there is a food inflation right now in India, and it is not because there is an increased demand suddenly which is causing inflation in food and in the broad category of primary articles. So you can clearly see that because of monsoons, and given that Indian agriculture depends on monsoon, so this expected negative supply shock is the reason why you have a inflation in the broad category of primary articles. Now there is even statistical evidence which substantiates this. So let's look at this chart where you can see parallel yellow lines which represent years in which India has witnessed significant drought, and then you have this blue line which talks about food inflation. So if you notice this graph, you'll notice that every time you have this parallel yellow line or straight yellow line, right after that you'll notice that there is an increase in food inflation. That is, every time you have a negative supply shock, say because of drought, then the subsequent year, because there's reduced supply, or in the subsequent duration because there's reduced supply, there is a rise in food inflation in the economy, as we've talked about right now. Now if you talk about the second broad category within the wholesale price index, you have fuel and power. Out here also, it's the war-induced supply shock which is the driver for inflation. We know that because of the Russia-Ukraine war as well as the US-Israel and Iran war, there is a reduced global supply of oil which has actually increased the global energy prices. So you have, because of war, a increase in global energy prices. Now we know that India imports almost 85% of its crude oil requirement. Now given that we import such a substantial amount of crude oil, and because global energy prices have increased, it has also resulted in a rise in prices of petrol, diesel as well as LPG in context of Indian economy. So again out here, because of disruption of supply which is happening because of external factors, that is because of wars which are happening globally, you have a inflation which is already started to happen at a wholesale level. So again out here, supply side factors are the reasons which are driving inflation at a wholesale level. Now let's talk about the third category of commodities, which are your manufactured products. So out here again you have supply side factors which are causing inflation, but out here specifically these supply side factors are increasing the cost of production. So that's why you have something which is specifically called a cost push inflation. So the way supply side factors are increasing the cost of production is that you, in manufacturing different commodities, fuel tends to be a key ingredient. In fact, if let's say you take an example of a biscuit company or a biscuit manufacturing company, now that company is going to require fuel to move raw materials to its factories, then it's also going to require fuel to power different machines as well as to transport the finished products to its warehouses as well as distribute those finished products from its warehouses to retailers so that they can eventually be sold to consumers. So let's say a particular biscuit company is producing biscuits and it has a cost price to manufacture those biscuits which is 20 rupees. Now let's say this company is keeping a profit margin of 5 rupees and the selling price of these biscuits in the market is 25 rupees. Now let's say because of this war, the prices of fuel has increased, and as a consequence of which its transportation cost, manufacturing costs and its distribution costs have all risen. So as a consequence of this, let's say to manufacture those biscuits, the cost price has increased to 23 rupees. Now if the company wants to keep its profit margins intact, the selling price will have to increase to 28 rupees from 25 rupees. So basically the increased cost of fuel, which is a key ingredient for manufacturing, has resulted in an increased price of final manufactured products. Now this is something which is happening in India across industries, across manufacturing commodities, and that is the key reason why you have a cost driven manufactured goods inflation in India. In fact, there is a chart which exactly demonstrates this. So if you look at this chart, you'll see that there is a one-on-one symmetry between fuel and power inflation and manufactured inflation. So if you see that every time in India there is a fuel and power inflation, there is a corresponding 1:1 manufactured inflation. So clearly, as the prices of raw materials increase, you will have a cost push inflation as this chart shows. So given this, what can the monetary authorities or what can RBI, which is India's central bank, do in this scenario? In short, RBI individually cannot do a lot in these scenarios, because what the monetary policy through which RBI controls inflation is that the monetary policy requires RBI to regulate the interest rate or actually increase the interest rate when inflation is high, so that the higher cost of borrowing eventually reduces demand. But out here you have inflation which is happening because of supply side factors. So if RBI, let's say, were to increase the interest rate, that is clearly not going to produce more rainfall, or that rise in interest rate is not actually going to impact the prices of crude oil globally. So clearly, given that inflation is caused because of supply side issues, it requires supply side solutions. That is, it requires government intervention. So that is the key driver, that is the main thing which needs to be done. That is, mainly the government needs to intervene. However, despite that, the monetary authority, that is RBI, still regulates the interest rate because it wants to still reduce the excess of demand which may happen in the economy and further aggravate this inflation. But primarily it is the government intervention which can help moderate the impact of inflation. Now if you talk about what can the government do in this context, so let's look at the three broad category of commodities which we talked about are being impacted by inflation. So if you talk about in context of food inflation, given that food inflation is happening because of a negative supply shock, because Indian agriculture is still primarily dependent on monsoons, so what is required is that the irrigation infrastructure needs to be improved. Secondly, the agricultural infrastructure needs to be improved so that there is better storage of vegetables, there is better storage of grains, as well as the logistics infrastructure also needs to be improved so that there is efficient transportation of goods, so that there is lesser amount of wastage and spoilage. The second broad category of commodities, if you talk about in context of fuel inflation, so while the government actually cannot regulate the prices of crude oil internationally because India imports and those prices are set based on global demand and supply. However, what India can do and what India did right now in the month of March was that it reduced the additional excise duty on petrol and diesel. So the moment the government reduced the additional excise duty on petrol and diesel, it helped moderate the increase in prices of fuel and diesel which could have happened for the retail consumers, because oil marketing companies which were importing oil, they were already paying a much higher price to import the crude oil, and they were also being asked to sell the retail diesel and petrol at a regulated price. So now, given that this tax component was reduced, it was reducing the losses which these oil marketing companies had to bear by themselves. So net, the impact on the retail consumer which could have happened was moderated, and as a consequence of this, the overall cost of manufacturing goods that time wasn't that high. However, over a period of time, because these taxes which were waived off have again been reinstated, so as a consequence of this, the cost to manufacture has actually increased, and as a consequence of that, you're witnessing what is a inflation in the manufactured group of commodities. So this is all we wanted to discuss in context of inflation which is happening right now in India. I hope you liked this video. If you did, follow the channel for more such concepts in regards to UPSC economics. Thank you so much for watching.